Hello, and welcome to NestEggGuru. In this tutorial, we're going to illustrate the importance of accounting for the current low interest rates on bonds and cash in planning one's retirement income. Before we begin, however, one point that everyone should understand is that regardless of which app you are using, no retirement simulation calculator has any predictive value. No app is a crystal ball. Instead, what a retirement application should be used for is a tool for stress testing one's retirement strategy to see how it might hold up under potentially adverse conditions. To this end, it is obviously important that the inputs and assumptions of the calculators you are using are not overly optimistic. Today, we will demonstrate this by running two different retirement spending applications side by side. First, let's run Vanguard's popular retirement nest egg calculator. This simple online Monte Carlo simulation app features an intuitive design that makes it easy for consumers to test how long their retirement nest eggs may last. In this example, we're going to test the sustainability of a $1 million retirement nest egg over a 30-year time horizon using a $45,000 initial withdrawal amount that is adjusted annually for inflation. We have set the initial broad asset allocation at 50% stocks, 30% bonds, and 20% cash. Let's run the simulations to test the results. In viewing the Vanguard nest egg calculator results, it's worth mentioning that the NestEggGuru prefers to avoid using the word probability, as the term implies that the results are predictive. The statistic presented in the Vanguard results simply means that the portfolio did not run out of money in 85% of the simulations that were generated. Now let's compare this analysis to a similar one using NestEggGuru. NestEggGuru also features an intuitive design, but it is a bit more sophisticated in terms of the number of inputs it allows users to enter. As you can see, I have pre-populated the inputs to be as analogous as possible to what we entered in Vanguard. We have the same 30-year time horizon, a $1 million initial nest egg, and a $45,000 initial withdrawal amount. One difference, however, is that the Vanguard app internally simulates the annual inflation adjustment, while NestEggGuru allows users to test on their own how different annual cost of living adjustments may impact sustainability. In this case, we will be using a 3% annual inflation adjustment, which is roughly in line with the mean historical inflation rate inherent in the Vanguard app. NestEggGuru also allows users to manually account for future anticipated changes in their income needs, but in this example, we are going to assume no future changes beyond the 3% annual inflation adjustment. As you can see, we have set the broad allocation again to 50% stocks, 30% bonds, and 20% cash. Since the Vanguard application only employs a single US large cap stock market index in its simulations, NestEggGuru will also assume a similar 100% large cap US allocation as well. However, instead of sampling from historic bond market returns as Vanguard does, let's instead enter a bond yield that investors might realistically be able to attain today. At this particular moment, the 10-year Treasury yield sits at around 2.2%, but let's assume that an investor can get 3% on a long-term CD or perhaps a 10-year corporate bond. For cash, instead of randomly sampling from historic T-bill returns as Vanguard does, let's assume that the yield on cash is 0%, which again realistically reflects the current yield environment. NestEggGuru also permits users to incorporate the impact of internal investment expenses and investment advisory fees. However, since the Vanguard calculator does not account for the expenses, we will assume zero expenses as well. Lastly, like most calculators, the Vanguard application assumes that retirees withdraw proportionally from stocks, bonds, and cash and rebalance annually. While NestEggGuru maintains that this is not necessarily an efficient withdrawal strategy, to make the analysis apples to apples as much as possible, we will assume the same. Now, let's run the analysis. Wow, as you can see, in NestEggGuru simulations, our retirement nest egg was depleted before the 30-year period in 64% of the simulations compared to just 15% of the simulations in the Vanguard. What's more, if we scroll down to look at the detailed simulation results that NestEggGuru provides, we find that in the worst 10% of the simulations, the portfolio was depleted in less than 25 years. So, what gives? What could possibly account for two calculators featuring similar designs and methodologies producing such dramatically different results? We believe the answer lies in the bond and cash return assumptions. The Vanguard application derives its bond market returns from randomly sampling historical bond and T-bill data going back to 1926. However, the mean return for bonds and T-bills over this period of time are significantly higher than the returns retirees can reasonably expect to earn today. In contrast, NestEggGuru allows users to test the possibility that rates stay low and do not revert to the historic means anytime soon. This difference likely accounts for the significantly more optimistic results on the Vanguard calculator. From the perspective of stress testing, NestEggGuru believes that such optimism does not adequately reflect the depletion risk today's retirees face if interest rates remain low for the foreseeable future. This tutorial also serves as a great example of how all retirement simulation calculators produce different results, and why it is critically important to understand whether the assumptions the tools you are using are realistic and reasonably reflect your real-world strategy. We hope you found this tutorial helpful. NestEggGuru, Enlightened Retirement Planning.